Where should investors be looking for value in tech right now?
Well, look, the group on average is back to the midpoint of where it's been trading over the last 5 years. It's trading around 15 times EV to EBITDA. We think that's a pretty attractive entry point. We put out a 2019 outlook piece last week where we identified our top 5 picks, and it starts with Amazon first and foremost, then Google, then Facebook, and then Expedia. So clearly, we think there is clear value, particularly among some of the larger cap names at this point.
Aaron, I'll put the same question to you.
Yeah, we think the value is in the large cap side right now as well. A little bit of a contrarian call. We still like Alibaba here despite some of the China tariff issues. We think if that gets resolved, you have a company based on a sum of the parts basis trades around 10 times our core commerce business there. And even though you've seen growth slow a bit, if you look at the December data, which was released yesterday, China e-commerce is still growing about 25% in December. It did slow to about 21% for the December quarter, but at 10 times earnings for the core commerce business, we think that's pretty attractive. Still like Google, pretty reasonable multiple, still growing kind of mid-teens on your core search business. And then Facebook, obviously, despite the issues, still growing. We look for mid-20s growth, trading at around 15 times earnings. We think if sentiment gets a little more positive on Facebook this year, we think you could see Facebook rally as well.
Youssef, tell us more about your case for Facebook. You got a pretty strong price target on it given where it currently is. Do you view that the negative sentiment has largely played out and now it's time to get back to fundamentals? Is there anything that the company has to show us to further solidify that?
Well, I think it's a tale of two cities. On the one hand, you have the fundamentals, the P&L fundamentals of the story, and those continue to actually perform towards the higher end of expectations. Our checks intra-quarter would suggest that mid-20s to maybe even high 20s year-on-year growth is what they're going to report. The question is what they're going to guide to 2019. We think you're still looking at a plus 20%. That tells you that advertisers are continuing to vote with their dollars. On the regulatory front, on a news flow front, that's a different story. I think what you're seeing from the regulators is likely, frankly, to get worse before it gets better. But to the extent that it's not necessarily seeping into advertiser psyche, I think the stock has already reflected much of that downside from a PR standpoint and should, can start working from here. So. Facebook remains a top 3 pick. As Aaron said, you're looking at mid-20s, maybe higher top line growth. Margins, I think we're probably going to trough the margins in the mid-30s. That's a big question that's going to come up on the call. But if that's a fact, then I think the stock definitely rallies from here.
Aaron, Amazon, there's a report in the Wall Street Journal today that the company is looking to woo shippers with fewer fees than FedEx and UPS. Every time we get some sort of story around Amazon's ambitions to build out its own transportation network, shares of FedEx and UPS trade lower on this. But is it actually looking to do that? Is it looking to become an actual competitor to the delivery giants that are out there already?
Yeah, we think it depends on what geographic area. So in, I think, dense urban areas, we think it probably does make sense for Amazon to do more themselves. I think the economics make sense for them. Maybe more suburban, more rural areas, probably doesn't make as much sense for them to invest in that. But we think in cities like San Francisco and New York, you start to see a lot of delivery vans. It can make sense economically for them to insource more of the delivery services for themselves.
Youssef, you mentioned Google. I've heard a couple times today, in fact, from some who say Facebook remains their favorite pick for the year. But as for big tech names that are going to benefit most from the earnings print, Google's on top. I wonder if you are anywhere near agreement, and if so, why?
So search advertising remains really strong. And in fact, some sources would indicate that Q4 search revenues may even have accelerated a bit. It may have benefited a little bit, so Google may have benefited on the margin from what's happening to the social spend. But generally, expectations for Google have been relatively muted, and the company continues to perform towards the higher end of those expectations. The other thing is, from a valuation standpoint, Google is by far the cheapest mega cap in our universe, trading about 9 times cash flow. In fact, ex cash, it's trading basically virtually in line with the overall S&P, while the S&P is growing at 3%. Google is still growing at 15 or 20%. So that's why I think there is a fair amount of excitement around Google, particularly in a market where people are adopting some risk off, then Google seems like a perfect candidate for that kind of investment.
Aaron, you got this hold on Twitter. People have underestimated it in the past. Why do you think it's already had its run?
Yeah, I mean, so if you look at valuations, it's still not cheap here. It's around 6 times revenues on our estimates. We think they are performing better. You've seen user growth improve to kind of low double digits here. But we're still not hearing from advertisers that much excitement. They are coming back to it somewhat, but we'd like to see faster revenue growth, more 15 to 20%. You're still growing kind of revenues maybe in the 10% range is the outlook right now. So for a company that's at 6 times revenues, growing 10%, it doesn't excite us right now. If we start to see better earnings leverage or accelerated revenue growth, we would look to get more positive.
Youssef, Elliott comes out yesterday and calls for a breakup of eBay, sends the shares higher. A, do you think that's a good idea? And B, we've seen these types of breakups in other sectors and other industries, but not as much in tech. Do you think this is the start of a bigger trend?
Well, so is it a good idea? I think it's a great idea, and that's because eBay continues to be the second largest e-commerce platform. They continue to have a really strong brand, but operationally, I think you've seen some failures to even meet management's own expectations. This is not a business that's keeping up with overall e-commerce trends. They're only growing low to mid single digits year on year when e-commerce is growing 15%. So something has to be done. And as we saw back in 2015 when PayPal was spun off, it created a ton of shareholder value. Now, both StubHub and Classifieds are not nearly the size of PayPal, but there is definitely some value to be extracted there. In terms of trends, at least within the internet and digital media space, we don't really have that many eBay-like portfolio companies with a ton of really valuable assets. So I don't necessarily think this is a beginning of a trend, at least within this particular subsegment.